Welcome to Sheen Research, your strategic partner in comprehensive investment analysis.
It's great to be here. Today we are setting our sights on the industrial sector, but this isn't your grandfather's smokestack industrial company.
No, not at all. We're looking at a company that's really, you could argue, the invisible backbone of the modern defense economy and the whole aerospace resurgence.
That's a bold claim, the invisible backbone.
I think it holds up. We're talking about RBC Bearings Incorporated, ticker symbol RBC.
And it's important to set the stage right away. Before anyone thinks we're about to spend an hour on, the simple ball bearings in a skateboard or a fidget spinner, we need to completely reset the scale of what we're discussing.
Right. This is about highly engineered precision components. We're talking about the parts that stop a commercial jet's landing gear from collapsing on impact.
Or the parts that keep a nuclear submarine hull from, imploding under pressure.
Mhm.
Or the bearings that allow a massive mining crusher to run 24/7 without seizing up.
Exactly. These are mission-critical applications. There's zero room for error.
Zero. If a bearing in your fidget spinner fails, you're, mildly annoyed?
Mm-hmm.
If a bearing fails in the guidance system of a missile or in the main rotor of a helicopter, that's catastrophic. That's the world RBC lives in.
And the reason we're diving in right now is because there's this real tension in the company story.
There really is.
They just reported their second quarter fiscal 2026 earnings. This is for the period ending September 27th, 2025. And they're showing absolutely massive growth in their backlog, specifically in defense.
And this is the but, the stock is trading at a valuation that, it would make a high-flying tech investor blush. CFRA, for instance, has a hold rating on it.
So that's the core debate, isn't it? Is this company so good, so essential, that it actually deserves this sort of nosebleed valuation? Or is the market just getting way ahead of itself?
That's our mission today. We're going to tear apart these earnings. We're going to look at the big acquisition they just made and really try to synthesize if this industrial stalwart is a trap or a treasure.
Okay, let's get into it. And let's start where we always do. The headlines, the raw numbers from this Q2 fiscal 2026 report. What did the scorecard look like?
All right, top line first. Net sales came in at $455.3 million.
Okay, and for context, what kind of growth is that?
That's a 14.4% increase compared to the same quarter last year. So pretty robust growth.
14.4% is very solid, and they beat expectations, I believe.
They did. They beat the analyst consensus by about $5.3 million.
Now, $5 million to some people might sound like a rounding error on a number that big, but in the industrial space, where so much is based on long-term contracts and revenues, usually pretty predictable. A beat like that is significant, isn't it?
It is significant. It signals that demand is running hotter than even the professional models were predicting. Something is accelerating.
Okay, so that's the top line. Let's move down the income statement to the bottom line. What are we seeing with profits?
GAAP net income was $60.0 million. That's up from $54.2 million last year.
Okay.
And that translates to a GAAP EPS earnings per share of $1.90. That's on a diluted basis.
But then we get the other number, the adjusted EPS, which came in at a whopping $2.88 per share.
And that $2.88 beat expectations by a very healthy $1.15.
I really want to pause here for a second because this is a point that trips up a lot of people. The difference between $1.90 in GAAP earnings and $2.88 in adjusted earnings is massive. That's almost a full dollar per share of adjustments. We can't just gloss over that. What's actually going on there?
This is such a crucial point to understand with this company right now. A huge, huge chunk of that difference comes down to something called purchase accounting. And it's tied directly to their recent acquisition of a company called VACO.
So when they buy a company, accounting rules force them to do something that makes their profit look smaller than it really is.
That's a perfect way to put it. Let me give you a simple analogy. Imagine you buy a furniture store.
Okay.
And that store has a sofa on the floor that cost the original owner $500 to make. But when you buy the business, the accountants step in and say, nope, the fair market value of that sofa today is $900. So we're putting it on your new books at $900.
Right.
The next week, you sell that sofa for $1,000. For accounting purposes, your profit is only $100. The difference between the sale price and that inflated book value.
But in reality, from a cash perspective, I made $500.
Precisely. The accounting rules artificially inflate your cost of goods sold, which in turn artificially depresses your GAAP earnings for a little while, right after an acquisition.
It's a non-cash charge. It looks like a cost, but no actual money left the building for that specific item. It's just a paper adjustment.
You got it. So when we look at that adjusted EPS of $2.88,
Mm.
what they're doing is adding back those, fake accounting costs to show you the true underlying operating power of the business. That's why the adjusted number is the one the market really focuses on.
That makes perfect sense. And speaking of true operating power, we absolutely have to talk about cash flow. This was the number in the report that really made me sit up and take notice.
Oh, the cash flow was phenomenal. For the first 6 months of the fiscal year, operating cash flow was $208.4 million.
And that's up from what, about $140 million last year?
Correct. Up from $140.4 million. But the really eye-popping metric, the one you highlighted, was the free cash flow conversion rate.
Mhm.
For this quarter, it was 119.5%.
Okay, let's stop on that 119% number because that is rare. It's one thing to report net income, which is ultimately an accounting opinion, but cash flow is a fact. The money is either in the bank or it isn't.
Mm-hmm.
When you see a company generating almost 20% more actual cash than their reported adjusted profit, what is happening under the hood?
It tells you they have an absolute superpower when it comes to managing working capital.
Explain that.
In an industrial business, you have enormous amounts of cash tied up in inventory. Raw steel, parts that are half-finished, finished bearings sitting on a shelf waiting to be shipped. It's a huge cash drain.
Right.
A conversion rate of 119% means they are so efficient. They're collecting cash from their customers faster than they're paying their suppliers, and they're turning that physical inventory into cash on the balance sheet with incredible speed.
So they aren't just selling bearings, they're managing the flow and timing of money better than almost anyone in their peer group.
Exactly. It completely validates the quality of the earnings.
Yeah.
You sometimes see companies with high profits but negative cash flow because they aren't collecting their bills. RBC is the polar opposite. They are a cash-generating machine.
So to sum up the headlines, the financials are incredibly robust. Revenue beat expectations, earnings beat expectations, and the cash flow is, frankly, stellar.
A very strong quarter, no doubt about it.
But if we start to peel back the onion here, this isn't a uniform success story across the entire company. It really feels like we're looking at a tale of two economies.
That is the perfect way to frame it. RBC reports in two main segments, aerospace, defense, and industrial. And right now, those two engines are running at vastly, vastly different speeds. It's almost like looking at two completely different companies that just happen to share the same roof.
So let's start with the race car in the garage. The aerospace and defense segment, what were the numbers there?
Revenue for A&D was $198.8 million. That is up nearly 40% year over year.
38.8% to be exact, a huge number.
Huge. And the context from management is vital here. The CEO, Dr. Michael Hartnett, he used a very specific phrase on the earnings call. He said this segment is racing to parity with the industrial side.
Which is a big shift, right? Historically, RBC was an industrial company that, also did some aerospace work.
It was. Now it's becoming a 50-50 proposition. Right now, industrial is about 56% of total revenue, and aerospace defense is 44%.
But with A&D growing at almost 40% and industrial basically flat, that crossover point is coming very, very soon.
It's just a matter of a few quarters, I would think.
Okay, let's drill down even further inside that A&D segment, the defense part. Sales there skyrocketed 73.3%. I mean, 73% growth. It's something you expect from a software startup, not a company that bends metal. What on earth is driving that?
A lot of it, we should say up front, is that VACO acquisition, which is almost entirely defense. We'll get to that in a minute. But the organic drivers are all about geopolitics. We're seeing a massive, massive ramp up in demand from marine applications.
And when we say marine, we're talking about one thing in particular, aren't we? Submarines.
We're talking about submarines, specifically the Virginia-class attack submarines and the new Columbia-class boats.
The Columbia-class is the new ballistic missile submarine, the cornerstone of the nuclear deterrent.
It is. And these are not projects that get canceled based on who's in the White House. These are multi-decade government-funded commitments. The bearings, the valves, the components that go into these subs have to withstand unbelievable conditions, extreme pressure, saltwater corrosion, shock from weapons fire.
You're not buying these parts off the shelf at Granger.
No, you don't buy these off Amazon. They are proprietary, often sole-sourced parts that are designed years in advance.
And the report mentioned that VACO contributed about $24.7 million in sales this quarter, mostly to that defense line.
That's right. But even taking that out, the growth is still impressive. And look at commercial aerospace. It's also holding its own, up 21.6%.
Which is pretty remarkable given the mess we constantly read about with the big OEMs, the original equipment manufacturers.
You'd think so, wouldn't you? We see headlines every single day about Boeing's production delays, their supply chain nightmares, the regulatory hurdles, and yet RBC's commercial aero business is up over 20%.
So how does that work? If Boeing is building fewer planes than they'd like, shouldn't RBC be selling fewer bearings?
Well, there's a bit of a lag effect, and it's also about the aftermarket, MRO maintenance, repair, and overhaul. But the primary driver is that despite all the negative headlines, the actual build rates are slowly ticking up from the pandemic lows.
I see.
And you have to remember, RBC supplies Airbus too, so they aren't tied to just one customer. If you're a key supplier on the right platforms, like the Airbus A320neo or the Boeing 737 MAX, you are seeing volume increases, even if the overall picture for the OEMs looks challenging.
Okay, that's clear. Aerospace and defense is the golden child right now. It's the growth engine. So now we have to turn to the other sibling, the industrial segment.
The steady state.
The numbers here. Revenue, $256.5 million. And the growth rate, 0.7%.
Flat. As a pancake.
It feels like a total standstill. I mean, compared to the 40% growth in the other half of the business, it's a bit jarring.
It does, but we have to be really careful not to frame that as a failure. In this particular macroeconomic environment, flat is actually kind of a victory.
Explain that. Why is flat a win?
Because the broad industrial economy is incredibly choppy right now. It's not moving in one direction. And if you look at the breakdown of RBC's industrial sales, you see these very clear pockets of strength and weakness that really mirror what's happening in the broader economy.
Okay, so who were the winners?
The winners were markets like aggregates, cement, metals, grain processing, food and beverage, and warehousing logistics.
Let's connect the dots on that. Aggregates, cement, metals. That sounds like the infrastructure bill finally starting to work its way through the system.
100%. That is government money finally hitting the ground. You've got road building, bridge repairs, massive new construction projects. All of that heavy machinery needs heavy-duty bearings that can take a beating.
And warehousing and logistics, that's the continued build-out of the e-commerce supply chain, I assume?
Correct. More automated warehouses, more conveyor systems, they all run on bearings.
But then you have the losers. You mentioned pockets of weakness.
Yes, the weak spots were oil and gas, semiconductor machinery, and European machine tools.
And that makes sense, too. Oil and gas is famously cyclical, and it's been a bit soft lately. Semiconductor machinery is taking a well-deserved breather after a historic boom. And Europe's industrial base, well, it's been flirting with recession for a while now.
Exactly. So for RBC's total industrial segment to come out flat, it means the strength in infrastructure and logistics is perfectly offsetting the weakness in energy and high-tech capital goods. It's a testament to their diversification.
And here's the part that I found most impressive. This is the real kicker. Despite sales being completely flat, the margins in the industrial segment actually went up.
Yes, significantly. Gross margin expanded from 46.0% in the prior year to 48.2% this year.
That, to me, is the real story of the quarter for that segment. You're selling the exact same amount of product, but you're making significantly more profit on every dollar of sales.
It speaks volumes about their operational leverage and their pricing power. It means they're managing their factory floors so efficiently that they can squeeze more and more juice out of the same orange. It's really impressive execution.
So to recap the segments, we have a defensive, high-margin industrial business acting as a steady anchor. And we have an aerospace and defense business acting as a turbocharger.
That's the perfect analogy.
Which brings us to the fuel they just poured into that turbocharger, the VCCO acquisition.
This was a major, major strategic move for them. They closed the deal to buy VCO in July of 2025. The impact on the cash flow statement was a $275 million outflow.
And for anyone not familiar, what does VCCO actually do?
They make highly specialized valves, filters, and regulators. And again, their main customers are in defense and space. Think submarines, satellites, rockets.
So it fits right into that high-spec, mission-critical sweet spot.
Perfectly. And when you look at what this single acquisition did to RBC's backlog, the numbers are just mind-blowing.
The backlog numbers are, frankly, eye-popping. As of the end of September, the company's total order backlog hit $1.6 billion.
$1.6 billion.
Let's put that in perspective. I mean, imagine walking into your job on Monday morning and seeing a stack of orders on your desk that guarantees your salary for the next 2 years. That's essentially what RBC has.
And look at the growth. Back in March of 2025, the backlog was $940 million. A year ago, it was $860 million. So they've nearly doubled it in just 6 months.
That's incredible. How much of that came from VCO?
About $500 million of that increase came directly from the VCOE acquisition. So they essentially went out and bought a massive book of guaranteed future business.
And here's the most important statistic, I think. Over 90% of that entire $1.6 billion backlog is now in aerospace and defense.
That's the identity shift we were talking about. This is no longer an industrial company with an aerospace division. They are rapidly becoming a defense prime supplier that is disguised as a bearing company.
They really are. And that has huge implications for valuation, which I know we'll get to later. Defense contractors just get different multiples than cyclical industrial companies.
They absolutely do. But before we, pop the champagne on this deal, we do need to talk about the integration risks. Buying a company is the easy part. Actually running it and making it better is the hard part.
And management was pretty transparent about this on the call. They said they're still in the getting to know you phase. But Dr. Hartnett mentioned something that sounded like a pretty heavy lift.
He did. He said VACO needs to increase its production rates to meet demand, and RBC plans to use its own West Coast plant floor space to help VACO scale up.
This is the classic RBC playbook in action, isn't it? But it's not without risk.
Not at all. VACO is an engineering-heavy firm. They design brilliant, complex products, but maybe they aren't the absolute best at high-volume manufacturing. RBC is coming in and saying, look, we have empty floor space at our plant in Santa Fe Springs. Let's move some of your production lines over here and run them the highly efficient RBC way.
That sounds logical on paper, but moving a production line for nuclear submarine valves isn't like moving a desk in a computer.
Exactly. You have incredibly stringent certification issues with the Navy. You have the tribal knowledge of the workers who have been building these precise valves for 20 years. If you move the machine, but the master operator doesn't want to commute to the new plant, you've just lost decades of expertise.
So integration is where all the value from this deal is either going to be created or destroyed.
It's the whole ball game. And they did note that those purchase accounting adjustments we talked about earlier hit gross margins by about $3.3 million this quarter. So there is some initial financial friction in the gears already.
That's the short-term pain for the long-term gain, they hope.
That's the bet they're making.
All right, let's pivot and look forward. Let's talk about the guidance. What is management telling us to expect for the next quarter, Q3 of fiscal 2026?
They're forecasting revenue to be in a range between $454 million and $462 million.
And what does that imply for year-over-year growth?
That implies a growth rate of about 15.1% to 17.1%. So continued strong double-digit growth.
And they were good enough to break out the organic growth, right? Because with a big acquisition, the top-line number always looks huge and can be misleading.
They did, which is a sign of good, transparent governance. They expect the organic growth, so the core business excluding VACO, to be between 7.4% and 9.5%.
That's actually a really healthy number. High single-digit organic growth for a company this size in this environment is nothing to sneeze at. It confirms the core business isn't shrinking. It's still expanding nicely on its own.
It absolutely is. And because they're generating so much cash, their capital allocation strategy is crystal clear right now.
Yeah.
Deleveraging.
Paying down the debt they took on to buy VACO.
Aggressively. They borrowed $200 million on their revolving credit facility for the deal. They've already paid off $45 million of their term loan in Q2, and they made another $40 million payment right after the quarter ended on September 30th.
And their stated goal is to have that entire term loan paid off by November of 2026.
Yeah.
That feels incredibly fast. Why the big rush?
Because they want to reload the gun. RBC is a serial acquirer. This is their model. They leverage up the balance sheet, buy a high-quality, high-margin asset like Dodge or VACO, use their massive cash flow to pay down the debt at lightning speed, and then they're ready to do it all over again.
It's a rinse-and-repeat strategy that has clearly worked very well for them over the years.
It has. And they also extended their main credit facility out to 2030, so they have plenty of liquidity and runway. The balance sheet looks bulletproof, really. $91 million in cash, $5.1 billion in assets.
The risk of any kind of financial distress here is, well, it's virtually zero.
I would agree with that.
I want to shift gears a bit and talk about the qualitative side of things. The mood music from the earnings call. We got some really interesting commentary from management. Dr. Hartnett mentioned that their airframe plants are running at pretty much 100% capacity utilization.
Now, that is a classic double-edged sword.
How so? I mean, on the surface, 100% sounds great. It means you're completely sold out.
And it is great for margins. Your overhead absorption is perfect. Every machine, every worker is running full tilt, earning their keep. There's no waste. But it also means you are capped.
Mm.
You physically cannot produce one more part to sell.
So to grow from here, you have to invest. You have to add shifts, hire more people, or buy more machines.
Correct. And he said they are doing all of that, adding shifts, adding manpower, and making capital investments. But we all know how tight the labor market is for skilled machinists right now.
It's incredibly tight. And in aerospace, you can't just hire someone off the street. They need years of training and certifications. So hitting 100% capacity is a good problem to have, but it signals a potential bottleneck if demand surges even further.
It does. It shows they have pricing power,
Yeah.
but it also shows they're running hot.
And speaking of pricing power, there was a fantastic exchange on the call about their contracts with Boeing and Airbus. The analysts were pressing them about contract restrikes, basically renegotiating prices to account for inflation.
I absolutely loved the CEO's response here. It was just classic dry wit. He said, and I'm quoting, "Neither side was completely happy with the results, but we weren't disappointed."
Okay, let's translate that from CEO speak into plain English.
Translation: we got the price hike we needed. Think about it. If a supplier walks away from a tough negotiation with Boeing, a company legendary for squeezing its suppliers, and says we weren't disappointed, it means they successfully passed on their higher costs and then some.
It just highlights the moat around this business, doesn't it? If you're Boeing, you can't just wake up one day and switch to a cheaper bearing supplier for the landing gear on the 787.
You can't. The certification costs and the time involved would be astronomical. You are effectively married to RBC for the life of that airplane program, whether you like the price or not.
That is the very definition of a sticky, high-quality business.
It really is.
Now, I want to bring up what was, for me, the most entertaining part of the entire call, the humanoid robot discussion.
Oh, this was fascinating. A real glimpse into the company's culture.
So an analyst from Wall Street asks a question about embodied AI and humanoid robots. The premise is, hey, Tesla and all these other companies are building robots with joints. Joints need bearings. Are you guys going to be the key supplier for the Tesla Optimus robot?
A very forward-looking question.
It is. And Dr. Hartnett just shut it down with extreme prejudice. He dismissed the entire humanoid market as a commodity risk.
He did. And then he dropped this incredible line about AI in general. He said he uses AI to ask 5 questions every day, but then he pointedly emphasized, I don't pay for it.
I actually laughed out loud when I read that in the transcript. It was such a classic get off my lawn moment from an old school engineer.
It was. You have the entire market, the entire world, hyperventilating about the AI revolution, and the CEO of a $14 billion public company is basically saying, yeah, I use the free version of ChatGPT sometimes, but I'm not really impressed.
But let's debate this for a second. Is that a good thing or a bad thing? On one hand, it paints a picture of a very pragmatic, disciplined, no-hype engineering culture. They use robotics inside their plants to make things more efficient, but they aren't chasing the buzzword of the day.
I think that's the right read. It shows that they are incredibly disciplined. They want to be in markets with enormous barriers to entry nuclear submarines, commercial airplanes, markets where quality and reliability matter infinitely more than price.
Right.
The consumer robot market, that is going to be an absolute dogfight, a race to the bottom on price. Dr. Harton is essentially saying, I have zero interest in competing with a dozen Chinese manufacturers for the lowest cost bearing in a servant robot. I want to build the one bearing that keeps a multi-billion-dollar nuclear submarine quiet and undetectable.
That makes a lot of sense from a margin perspective. But I have to play devil's advocate. Isn't there a risk of missing the boat? If humanoids really do become the next auto industry, we're talking millions of units a year, isn't RBC turning its nose up at what could be the single biggest industrial growth driver of the next decade?
That is the classic innovator's dilemma, isn't it? By sticking to their high-margin, protected niche, they might miss the next mass-market explosion. But honestly, looking at their margins and their cash flow today, I think their shareholders are probably very happy they aren't off chasing speculative moonshots right now.
Okay, I think that's fair. We've praised this company for the last 20 minutes. We've talked about the incredible backlog, the expanding margins, the management discipline. Now we have to be the skunk at the garden party. We have to talk about the valuation.
This is where the rubber meets the road.
Yeah.
And it's a very bumpy road.
The stock is trading at a forward price-to-earnings ratio of roughly 37.1 times.
Correct. 37 times forward earnings.
Hold on. 37 times. We are talking about a company that bends metal for a living. NVIDIA trades at these kinds of multiples. High-growth software companies trade at these multiples. You were telling me a ball-bearing company deserves the same premium as the company powering the entire AI revolution. That feels like bubble territory.
It definitely feels like nosebleed territory. And for context, the peer average for industrial companies is somewhere around 20 times earnings. So RBC is trading at almost double the valuation of its direct competitors.
So why? What is the market seeing that justifies paying this massive premium? Is it just the defense hype?
It's what I would call the sleep well at night premium. To understand it, you have to look beyond the PE ratio and look at the quality and security of the revenue.
Okay.
Their own investor presentation highlights this. Over 70% of their sales are sole-sourced, single-sourced, or primary-sourced.
70%. That is an incredible number.
It's an incredible moat. It means for 70 cents of every dollar of revenue they bring in, the customer literally has nowhere else to go. Think about NVIDIA. They have competitors. AMD is chasing them. Intel is trying to chase them. Who is chasing RBC in the market for Columbia-class submarine valves? The answer is nobody.
So you're not paying for infinite growth. You're paying for monopoly-like security of the existing earnings stream.
Exactly. You are paying for the certainty that those earnings will still be there in 5 years, in 10 years, in 20 years. And in a very volatile and uncertain world, investors are willing to pay a massive premium for that kind of certainty.
I get that, but still, 37 times earnings. It feels like the stock is priced for absolute perfection. If there is any slip-up, if the integration of VACO gets messy, or if margins compress by even 100 basis points, that stock could get cut in half, and it would still be expensive compared to its peers.
That is the risk. You are 100% right. It's priced for flawless execution. That is why a firm like CFRA has a hold rating on it. They love the company, they love the growth story, but they look at the valuation score, and it's just a big red flag.
And it's worth mentioning the market risks, too. We said the industrial segment was flat. If the economy really takes a turn for the worse, if we see a real recession, that flat could easily turn into down 10%. Can the aerospace side really carry the whole company if industrial collapses?
That is the fear. And you always have program risks in aerospace. There was a good question on the call about the delays to the Boeing 777X program.
Right, the 777X has been delayed again and again.
But the CEO's answer on that was very smart. He said the 777X isn't even factored into their current financial plan.
Which is a brilliant way to manage expectations. Basically, we aren't counting on it, so if it's late again, we don't care. If it ever ships, it's just a bonus for us.
Exactly right. It insulates their guidance from Boeing's constant headline risk.
Let's do a quick peer check on profitability. Does that 37x multiple hold up any better when you look at their margins versus the competition?
It holds up a little better than you'd think. Their operating margin is 22.9%. The peer average is 20.4%, so they are structurally more profitable than their competitors.
Okay, but then I saw another metric, return on capital, where they looked much worse. RBC is at 5.9%, while the peer group is at 11%. Why are they so inefficient with their capital?
But they aren't inefficient. They're acquisitive. This is another accounting quirk. When you buy a company like VACO for hundreds of millions of dollars over its book value, all that extra money gets put on your balance sheet as an intangible asset called goodwill.
Right.
That goodwill bloats the capital part of the return on capital equation. The denominator gets huge because of all the acquisitions, which artificially drags down the percentage.
So it's a temporary optimal issue related to their growth strategy. As they pay down the debt and integrate the earnings from those acquisitions, that number should creep back up over time.
Correct. It's not a sign of poor operations. It's a sign of their M&A driven strategy.
Okay, so let's try to bring this all together. We have a hold rating from CFRA. We've got a stock price hovering near $500 a share. We have a 37x PE ratio that screams overvalued, but we also have a record backlog that essentially guarantees revenue for years to come, and a management team that executes like surgeons. What's the final synthesis here?
The synthesis is that RBC Bearings is a true high-quality compounder that is currently, fully, and perhaps overly valued by the market. It's like finding a pristine Ferrari, but the dealer is asking for the full sticker price plus a hefty markup.
So it's not a stock you sell because it's just too good of a business to let go of.
Right. You generally don't want to sell your winners just because they get expensive. Winners have a funny habit of staying expensive for a long time.
But at the same time, you probably don't back up the truck and buy a bunch more at these levels.
No, probably not. You keep it on your watch list. If the market has a broad panic attack someday, or if there's a big industrial sector sell-off that's unrelated to RBC's actual performance, and the stock drops 15–20%, that's your window of opportunity.
It's a classic stock to own for the long term, not to trade. And it's a stock that lets you sleep at night, as you said, assuming you can close your eyes and ignore that PE ratio.
And assuming you believe that the geopolitical tensions driving all that submarine and defense demand aren't going away anytime soon.
Which, unfortunately, seems like a pretty safe bet these days.
It does indeed.
Before we close out, I want to circle back to that robot discussion one last time. We kind of chuckled at the CEO's dismissal of it. But let's play devil's advocate for a moment. Is there a danger that RBC is becoming too specialized? They are betting the entire farm on aerospace and defense. If the world suddenly becomes peaceful, unlikely, I know. Or if air travel growth plateaus for some reason, do they have a plan C?
Well, their plan C is the industrial business. The mining, the cement, the infrastructure. But you're asking the right question. They are absolutely doubling down on what you might call the old world of heavy kinetic machinery. Their entire thesis is that physics doesn't change. Heavy things will always need to move. Moving things will always cause friction. And friction will always need bearings to reduce it. They're betting on the immutable laws of physics rather than the exponential change of Moore's law.
That is a profound way to put it. Getting on physics, not on software. It explains perfectly why they don't care about the AI hype. Friction is friction, whether it's the year 2025 or the year 2050.
Exactly. And right now, and for the foreseeable future, the business of reducing friction is a very, very profitable business to be in.
Well, there you have it. A really fascinating look into the machinery that powers our world. RBC Bearings, expensive, essential, and executing flawlessly.
A great case study in industrial strategy and capital allocation.
With that, we conclude our coverage for this video. Thanks for joining us. Sheen Research. Mindful markets, measurable meaning.